Corporate banks will give stellar returns over the next few years. That's the word coming in from market veteran Hiren, where the Alchemy Capital says that it is a good time to buy high-quality HFCs like HDFC.
The next cycle, upcycle, if we may say, in the Indian markets, will largely be led by large caps and larger mid caps. I mean, there will always be a few small caps and mid caps which will do well, which is always the case. There are always exceptions on both sides. But by and large, I still believe that the economic recovery post a very grueling 3-4 years where, you know, earnings have not increased. You've seen so much of disruption because of e-commerce competition, because of digital, because of demonetization, followed by GST, RERA, I mean, you name it. And I think by and large, I believe that well-run, stronger, larger companies will be better able to handle this kind of an economic environment and take away market share from the smaller guys. Because, you know, the other thing which got compounded was this whole liquidity tightness because of IL&FS, which is so bad for small and mid caps, right? Their ability to raise capital is hampered. The larger companies who have a good balance sheet can better manage this situation.
You mentioned corporate banks. So are you making a case that in the next 3 years ICICI Bank and SBI will make more money than HDFC Bank and IndusInd Bank?
So when I say more money, I think what we should understand is that the delta change in profits will be significantly different for corporate banks compared to the well-run retail-oriented banks. So their growth might continue, right? Having said that, it's not that HDFC Bank is not going after the corporate customers. I mean, they have the balance sheet, they have the relationships, so they will also benefit. But the delta swing that you will see in, you know, so profits which were dented because of high provisions, those will tail off next year and the year after. So you will see a very big swing in Axis, ICICI, SBI, the likes of that. And I think that's where incremental money will be made over the next 2 years.
We've seen a big shakeout in NBFC stocks. The so-called crowded trades have reversed completely. Typical market phenomenon: when the sector is in a boom period, everything goes higher. When the sector turns, the best and the fittest and the large ones only survive. Has that shakeout already happened in NBFC, and now would you say it's maybe in Bajaj Finance or maybe in Chola? I can talk about in Piramal. 4-5 names will survive, and that's why you should have bulk amount of concentration.
Yeah, so you know, Nikunj, is what you call the classic version 1.0 bull market in NBFCs is over. Like if you take any thematic move, you know, if you took tech companies pre-2000, right? Whether you bought an Infosys or a Satyam or a DSQ or whatever, right? You made money because that was version 1.0. Everything goes up. And investors are not able to differentiate the quality of the business. They are only looking at growth. They are only chasing growth. And it was so easy in a lending business to get growth. All you have to do is lend money, right? So nobody really focused on ALM mismatch, credit, you know, capacity to manage credit costs, etc. It's only when a crisis hits you and the entire sector derates and the men and the boys get separated, right? And that's what has happened as a result of the IL&FS crisis. So I think what you're likely to see now is a version 2.0, a cleaner version of the NBFC. So I, for one, don't believe that people say, oh, NBFC is dead. Nothing dies. It's just that the players get separated, right? So the Bajaj Finances of the world, or the, you know, very well run NBFCs like HDFC Limited in housing finance, I mean, these are well run. They've seen so many cycles and they've proven themselves over and over again. So after that brief correction, they will come back. They are the ones who will take away market share from the weaker guys. And the weaker guys are going to find it very difficult to raise capital.
Will you buy HFCs right now?
Well, we haven't bought HFCs purely because of the reason that the stock that we own, Bajaj Finance, is also making a big dent in the housing finance market. So we are happy to play it through a player that we are very comfortable with. But if it's a good high quality HFC like an HDFC, it's probably a good time to buy.
So how exactly have you altered your portfolio in 2018, given that we had a choppy ride for small cap stocks, a volatile ride for mid cap stocks, and a smooth ride for large cap stocks?
So I think we realized this pretty much by end of 2017, early 2018, that the small and mid cap space is very frothy. So we did two things. One is that we cut our exposure to small and mid caps. The ones that we really liked, we reduced our weight, but we still held a core position because we believed in the long-term story. And in small caps, you can't take a very short-term view, if you want to play the entire growth cycle. And what we did was that we bought the more larger cap, liquid, high-quality companies. Somehow, in my mind, the 2011-2013 falls had created a template that every few years you have this risk-off environment. And valuations were crazy. I mean, I can tell you that at the bottom of the cycle in 2013, as you rightly said, the CNX mid-cap index on a trailing to Nifty was trading at a 700 basis point discount.
It rarely happens.
Right? That in Jan 2018 was trading at a 2200 basis point premium to the Nifty. I mean, that told you the level of overvaluations. Now obviously that has come down. Part of it'll never go back in the discount because optically the valuations have look expensive for small mid cap because a lot of the smaller PSU banks had losses. So optically the PE looks higher. So I think we've seen a fair bit of contraction of that premium. My sense is that there may be a little more left. And while small and mid caps may bounce back from their absolute lows, but to my mind, and I could be wrong, I think that the next 2-3 years will be led by large caps and larger mid caps, not by small and mid caps.
But where do you see this massive scope of de-rating and re-rating? Like we've seen a case of de-rating in small cap stocks and we've seen a case of re-rating in corporate banks. In 2019, where do you think this theme will play out, in which category, in which business, in which particular subcategory?
So, I think that the well-run private banks will continue to do well. The big re-rating will happen in the NCLT cases, right? The corporate banks. I think we've just seen the first leg of the re-rating, and probably 2 legs of de-rating in the small mid-cap stocks. This might continue for a little while longer, right? Consumers, though, are expensive, and there is no doubt about that. But I think the problem is that people are so, have so realized that quality is important in India, and we're not getting the more levers and the Colgates and the Godrejes of the world. So money will go back to these companies. And I think what we are seeing now on the ground, especially 1 year before the elections, is a very typical phenomenon that we see where you've seen nothing short of a small stimulus being given, right? So we are seeing that the new RBI governor is infusing liquidity. So you're going to see benign liquidity. And they can take that risk because inflation is down to record lows. Oil prices have fallen. So, high oil prices is like a tax on consumers' wealth. With lower oil prices, lower food prices, there is that little scope. And then we have the Prime Minister saying that he's probably going to bring down the GST rates to 18 or lower for 99% of the items. So that's like a mini stimulus that you're seeing, which will play out over the next 6 to 9 months or 12 months going into the elections. And that's why I think though consumers are expensive, they will continue to do well. They will remain expensive because
auto, staples, durables, what will you buy?
So I think the big beneficiaries are likely to be staples at the absolute bottom end. Durables will also do well because one of the things that Modi promised and what he wanted to do was give 24/7 electricity to the smallest of villages. So if power is available, and if power is available free, I hope not, but if it's available free and if it's available, then people are going to buy consumer durables because what do you do with the power, right? So that will do well. And autos, I think, are at a cyclical low, which is a secular sector in India, but right now they're going through, a kind of a cyclical slowdown, but it will come back up next year. So all three will make money. Obviously, you have to pick and choose your stocks there.
What do you own?
What do we own?
In that entire theme.
So we own, we do own Maruti. we took a big bet on Bajaj Auto. We think that the new strategy change in Bajaj Auto makes the stock very interesting. Also, I think when markets were trading at 18, 19 times, you had Bajaj Auto trading at 13 times. It's a high quality management, cash in the balance sheet. Yeah. And I think finally they've realized that they need to start doing something about their market share. And they've started becoming aggressive, started to capture volumes. And what was the sense of having a 22% EBITDA margin when the second player has only 15% EBITDA margins? You could lower your EBITDA margins and take away some market share. And once you get that market share and the demand comes back and you get the customer back into the showroom, then you can upsell him your premium bikes. Plus, three-wheelers is a cash cow for them. And nobody is talking exports. I mean, with the rupee now depreciating, the exports markets could revive, and nobody else has been able to make a mark in exports as much as Bajaj has done. So I think it's a great combination. And now if you have again liquidity becoming to be benign, then two-wheelers might continue to do well. So we looked at companies that had not done much over the last few years, the Axis's, the ICICI, the Bajaj Autos of the world, where people were not consensus bullish. And if you believe that things are turning there, then incrementally that's where I think money is going to be made. So if, yes, an HDFC Bank and a Bajaj Finance and a, XYZ will make you that steady returns. But where you make that incremental alpha, the incremental alpha will be made where starting valuations are reasonable, there is a rate of change or delta in earnings, and these are not over-owned. That's going to be the theme.
I'll like to draw your attention to the cozy trade of 2018.
Yeah.
Short weakness in rupee translated into strength for IT.
Right.
And TCS has added phenomenal market cap this year.
Right.
What happens to the currency interplayers? Because they were the holding fort for markets. They are large weighted stocks.
Yeah.
Liquid stocks. FIs own them. If that trade reverses, could that create pressure automatically?
So, well, if the rupee goes back to 68 or 67, I don't know. Maybe, these stocks may not deliver returns. But if the rupee stays in the 70 odd range, obviously a TCS can't repeat the 40-50% return that it gave in 2018, but it could still give you a safe compounding. I think the lesson is that in India, you keep every few years or once in a while you have these risk-off environments which puts pressure on the rupee. So it's good to have some high quality exporters in your portfolio as a balancing act. So everything in every year is not going to give you the 20, 30, 40% return. That time for them is over. Probably they may give you a more 10, 15% return. I don't think tech spending per se will slow down. And TCS obviously has done well. Our bet has been more not so much on the large cap tech companies, but on two mid-cap tech companies which have done phenomenally well in terms of performance, and where we think that they can, because of certain reasons, the kind of end markets that they focus on, like L&T Technology Services or Tata Elxsi, where they can grow at a faster clip than the big guys can grow.
You still own Tata Elxsi? It's been one of your jackpot stocks.
Yeah, we still own it. We still are, fairly positive and bullish on it. I think that the three end markets that they serve, which is automotive, broadcasting, and medical electronics, are all getting disrupted. And I see continuous demand in these sectors, and the skill sets that they've developed are very unique. So we think these are long-term plays. There could be ups and downs in between, but by and large both LTTS and Tata Elxsi have done phenomenally.